Hey folks, welcome back to my channel, SafDT. Today we are diving into a hot topic. Is investing just like gambling? Buckle up because we are going to explore the surprising similarities and the key differences between poker and the world of finance. Well, it might not be obvious at first glance, investing and poker actually have a lot in common. On the surface, they both involve calculated risk-taking, require keeping your emotions in check, and can involve luck for short-term success, but need considerable skill to win out in the long run. In fact, a study found that fund managers who do well in poker tournaments also boast a significantly better investment return. But of course, I'm not sure how true this is, as personally we should always take things with a pinch of salt. Nonetheless, theoretically speaking, it makes sense that some of them actually sound very familiar. However, we definitely will go through the differences as well to be fair. Let's start with their similarities. First, let's address the elephant in the room. There are indeed some parallels between poker and investing. So, the first thing that to me is pretty obvious is distinguishing between luck from skill. In poker, you can't predict or control the cards you are dealt, but you can actually master the game strategy, reading opponents, which can be from facial expression to body language, and also making calculated risks. This last one is more of like knowing when to bluff, raise your stakes, or even folding. Similarly, in investing, the market has random elements. As much as we all know that the big boys kind of control the market, there are still random elements as there are also retail investors as well. However, you can still do your own extensive research, analyzing the companies or funds or whatever it is that you want to invest in, and build a diversified portfolio to mitigate your risk management. But generally, maintaining a consistent decision-making process ensures that over time, you still have more favorable outcomes. So, the second one is also pretty obvious to me, which is emotional control. I mean, you have to maintain your composure and facial expressions. That means you totally can't let your emotion to control you. Keeping a cool head under pressure is crucial to avoid emotional decisions that can cost you your chips. Similarly, in investing, one doesn't just panic sell during the dips or whatever negative events there are. Stay focused on your long-term strategy and avoid emotional reactions to market fluctuations. So as you can see, both poker and investing can be emotional roller coasters, but it's vital to avoid making decisions based on your emotions. Think of it this way. The best poker players play the same no matter which way the last hand went. To be frank, I thought of a few people that I follow when I was thinking about this. Two of them, probably you know, they are Warren Buffett and Charlie Munger. Similarly, emotional control ensures that investors remain level-headed in times of volatility. It's always easier to panic and sell during downturns, potentially at the worst possible time. But in most cases, you are probably better off staying invested over the long run with a well-diversified portfolio. So here's a diagram by JP Morgan, not by me, that shows it. Of course, having your own research and due diligence will be best for yourself, but here it is. Now, the third one, diversification is key. In poker, spreading your bets across different hands minimizes risk and maximizes opportunities. While in investing, diversify your portfolio across asset classes like stocks, bonds, and real estate to balance risk and potential returns. Just as poker players won't go all in on every hand, investors should not put all their money into a single stock or asset class. So with proper diversification, you can actually mitigate the potential downside that a single stock's poor performance can have on your portfolio. So for example, if you have this one particular stock that fall down 100%, your portfolio pretty much lost 100% of it. But if let's say you have 20 stocks and only one of it fall 100%, you only have 19 stocks left in your portfolio that can still help to mitigate all the losses, basically. Yeah. And of course, individual asset classes behave differently depending on the economic environment. So one can be up while the other asset class can be down. So still, you can better withstand changing economic situations by combining multiple asset classes in a portfolio. So basically, to summarize it all, it is all about sharpening your skills. Alright? Now, to their key differences. Well, to be fair, these are what make investing different from gambling fundamentally. So number one, information and analysis. In poker, while it is based on incomplete information, you can bluff and read your opponents, right? In investing, however, you have access to vast amounts of data, company reports, and financial analysis to make informed decisions, or rather to make a better informed decisions, and so that you are not easily swayed by people, because there's this thing called market sentiment where it's just all about people's sentiment towards market. Additionally, I was recently told by someone who has the utmost conviction in technical analysis, which technically can help you in some way too. So yeah, I mean, technical analysis is still some form of analysis which a lot of people actually still use it. And number two, edge over the house, or known as the house advantage. The casino always has a house edge, meaning they are statistically more likely to win in the long run. I'm not sure if you have heard about it, but people usually say the house always wins. Like, yeah, I mean, why not, right? In investing, however, over time, the stock market has historically provided positive returns, offering a potential edge over inflation and other financial instruments. And probably if you go and Google it, it's very easy to find out such chart, which is basically showing how it is going from the bottom, left bottom, all the way to right up, like all the way until 2024. So yeah. And number three, sustainable strategies. In poker, short-term wins can be fleeting and long-term success relies heavily on luck, like heavily. In investing, with some strategies like dollar cost averaging and asset allocation, you can build wealth over the long term, potentially regardless of short-term market fluctuations. I mean, okay, maybe don't take it from me, because I don't believe in gambling. Even though I know how to play poker, I just don't play with any real money because of all this luck thing. And I mean, it literally relies heavily on your luck on the long term, unless you actually cheat on some way or form, like memorizing of cards. Please don't do that, you'll be caught and thrown to jail. You generally cannot win the long term, man. Like, you can only win the short term wins. And that's why I actually know some people who, after win a couple of times in the short term, they actually quit, because it's better to get that profit, you know, the thing that you earn from the gambling, and then you do it something else rather than you investing in the long term, because rather than playing in the long term, because the success rate is just not there. Plus, please don't gambling, guys, please don't. So investing with sound strategies like dollar cost averaging and asset allocation, and with historically shown market movement, the potential is much higher in a sense. But of course, everything is not certain, especially ever since COVID. If you guys follow it closely, some of the hedge fund managers actually close down and stuff like that. There's a reason for that, so still be careful. But yeah, if I have to summarize it, not all bets are equal. But seriously guys, please don't gamble. It's called gambling for a reason, and investing is definitely not quite like gambling. While some skills translate, do remember that investing is about creating a calculated edge through knowledge analysis and diversification so that you can manage your risk. While gambling is more about chance and short-term wins with the odds often stacked against you. So yeah, don't play. So by approaching investing with a strategic mindset and responsible practices, you can reap the rewards without the unnecessary risks associated with gambling. So there are definitely differences there. So alright, that's all folks for today's video. What are some other lessons that you can think of that we probably can learn from? Do share them in the comment section below. I would love to hear them, and also don't forget to like and subscribe so that you don't miss anything. Thanks for listening folks. Stay informed, stay empowered. Until next time, peace.